This episode of On the Record is brought to you by Weisler Engineering.
Hey everyone, McCain Vogel here. I am in New Holland, Pennsylvania at the New Holland Manufacturing Plant, and welcome to On the Record.
During Ag Equipment Intelligence's executive briefing mid-year review on June 6th, we checked in with Pinion's Mark Johnson for an update on his forecast for the ag economy. Johnson says since December, the general economy has grown faster than was expected. For example, the S&P is up 11%, NASDAQ is also up 11%, and the Dow Jones is up 5%. The only thing not up, unfortunately, is corn prices. Back when Johnson presented for the executive briefing, corn prices were $4.66, and now they're down to $4.36.
The interest rate issue coming up, we've got a bunch of tax provisions expiring. None of that has changed. We've got a farm bill that has got a little bit of progress going since November. So that's a little bit good for you guys. It doesn't have everything in it that everybody wants, and it's got some stuff in it that some people don't want. So whether or not that passes in its current form, it's too early for me to even go through any of those details, I believe, on that farm bill, because I think it's a ways off. But some of the stuff we can go through, just another big thing that has that we've been talking about is we got 2030 that we're headed to as ag dealers. So there's a little bit of built up demand that's going to be swelling between now and 2030 with population change. And so just to kind of update that, we were heading towards a $10 or $11 billion person population. We're growing at about 82 million net a day. And that hadn't changed. It hasn't gone up or down. It's still just growing a lot. So we're still kind of on pace for that. So 2030 still looks like we're going to need about 30% more out of our existing crops than we've got now. So whether that's with higher prices, whether that's we got selling more equipment that gets more efficient and gets more yield out of the ground, whatever that is, we've got some work to do. And I think that our farm equipment guys are at the right spot for that.
Johnson adds that 2024 net cash farm income is expected to be $121 billion. That's down from $160 billion in 2023 and down from $202 billion back in 2022.
That one's actually been on the rise. It's 120 right now. Saying that we expect next year to be a little bit better than this year, primarily because we believe the Feds when they say we're going to decrease the interest rate. That happens, we're going to be a lot more positive about the future. So what does the Fed think? So I showed you this back in November. This is what stirred a lot of the talk. This Fed said, hey, we're looking for an interest rate down. We're looking for an inflation rate down in the 2 to 3%. And if we get that, we're looking to have interest rates down to 3%.
Based on all the different economic indicators, Johnson says Pinion's outlook for dealers currently is for 2% growth if we see an interest rate reduction. With some of the mainline OEMs predicting dealers will see 10 to 15% decreases, he warns dealers need to look hard at their forecasts and build in that decline to ensure they don't run out of cash.
I don't anticipate that that's going to be below 3 either. So that's not good. Now that's a lot better than it was in 23 and 22, but it's still above 3. And until we get under 3, we're probably not going to see an interest rate. That's what the Feds say.
This week's dealers on the move include Horizon Ag and Turf, Belcorp Ag, and WC Tractor. Canadian John Deere dealers Agland and Martin Deerline announced plans to merge, forming Horizon Ag and Turf effective July 31st. The combined group will have 13 locations. California John Deere dealer Belcorp Ag has acquired Thomason Tractor for a total of 8 locations. And 2024 Rural Lifestyle Dealer Dealership of the Year, WC Tractor, has acquired Hammer Equipment's 3 locations. Now over to Noah Newman for the latest from the Technology Corner.
Thank you very much, Kim. I had the chance to catch up with single-store John Deere dealer Ice Implement's Precision Ag team in Two Rivers, Wisconsin. And with busy season finally winding down a little bit, Precision Ag manager Eric Hagano and Precision Ag specialist Phil Davister had some time to reflect on just how much precision business has grown over the last several years and the types of equipment they're working with the most.
For us, it's always corn planters, getting fertilizer systems up and running. Side dress units now are big, so we got guys that are getting their side dresses out right now and getting them ready to go. We do some pull type sprayer work, but a lot of it's just general steering, just getting screens and receivers on tractors.
It's getting that first piece in their tractor, and after that, the second and third kind of take care of themselves. It's hard overcoming that initial sticker shock on the price tag, but then once growers get into it and see it, then they see the benefits and the phone calls come easier.
We always kid ourselves that every year we think we're going to run out of things to do, and it doesn't happen because a lot of these older growers are even grabbing onto this technology now. The things that John Deere is coming out with makes it a little more affordable. People are getting involved with it. They want to get involved with it. They see their neighbors got it, so now they want it. And yeah, we don't run out of work. We always think we're going to. It just hasn't happened.
Eric helped launch the Precision Ag team at ICE Implement about a decade ago, and it consists of 4 people, including an administrative person who helps take care of inventory and all the paperwork. And hey, we know that helps big time because Precision Ag specialists wear many hats, from parts and service to sales. In the Technology Corner, I'm Noah Newman. Back to you, Kim.
Thanks, Noah. Farmer sentiment improved in May following a sharp decline in April, according to Purdue's Ag Economy Barometer. May's reading of 108 was a 9-point improvement from April. Producers reported improvements in both the Current Conditions Index and Index of Future Expectations. Producers' plans for machinery purchases remain stable, but the majority still say their plans for equipment purchases are lower in the upcoming year compared to a year ago. The percentage of producers who said their plans were lower or higher both dropped compared to April. Rising interest rates continue to be the primary reason producers say it's a bad time to make large investments at 44%. Followed by the increasing price of farm machinery and new construction at 29%. As to reasons it's a good time to make large investments, 45% of producers who felt like it was a good time credited higher dealer inventories. Another 25% said it was due to strong cash flows. Used equipment inventories continue to put pressure on dealers' bottom line. The latest dealer sentiments report shows a net 11% of dealers say their used equipment inventory is too high compared to a net 7% the month prior. One dealer says, dealers are becoming less willing to lose large sums of money on used equipment to hit market share. They continue saying the manufacturers need to come up with programs that help move equipment. While dealers reported their overall used equipment inventories were up in the month, used combine and used high horsepower tractor inventories did see some improvement. A net 8% of dealers reported used combine inventories were too high versus a net 29% who said the same the month before. For used high horsepower tractors, a net 1% said their inventories were too high, down 23 points from the previous month. During Deere's second quarter earnings call with analysts, Josh Beal, Director of Investor Relations, said that while used combine inventories are up from decade lows, they remain below the highs seen in the last downturn. However, used high horsepower tractors have increased more rapidly, he says, and are skewing more predominantly to later models. This is driving up the average value of equipment, he says. Beal says this trend in used high horsepower tractors was a key factor in Deere's decision to underproduce retail demand in North America. This week's DataPoint is brought to you by the Dealership Mind Summit. The percentage of dealers forecasting sales growth of 2% or more in forage harvester sales for the year ahead improved from 2023, with 8.5% of dealers forecasting growth, according to the latest Dealer Business Outlook and Trends report. This percentage peaked in the last 5 years when just 13.7% of dealers were forecasting unit sales growth for 2021. That's it for this week's On the Record. As always, you can send comments and story suggestions to kschmidt@lestermedia.com. Until next time, I'm Kim Schmidt. Thanks for watching.